Hi, everyone. This is James Fields from Klingenstein Fields Wealth Advisors. So, I'll let you know, we are here. We're just going to wait a few more minutes as people are piling into the webinar, and we'll begin in a few minutes. Again, hi, everyone. It's James Fields of Klingenstein Fields. We're just going to wait a couple more minutes with people joining us. Hello, everyone, and thank you for joining us today. I'm James Fields, president of Klingenstein Fields Wealth Advisors. I'm glad you could join this call. I'm going to start off with what has become our traditional greeting, which is that I hope everyone continues to stay safe and healthy during these unprecedented times. We appreciate all the positive feedback that we've gotten regarding our previous webinars and other communications. While we've spoken to many of you individually, this is a great way to connect with all of you and give you our thoughts about what's going on, as well as highlight an area or topic that we believe is of particular relevance right now for eligible investors. As always, we encourage you to continue to reach out to us with any questions or concerns that you may have. We hope that you enjoyed our most recent What's New at Klingenstein Fields newsletter. We very much enjoyed sharing with you some of the things that we've been up to with our families, giving back to our local communities, and other activities. If you haven't had a chance to read it yet, you can find it on our website at klingenstein.com. Today, I'm going to give a brief update on what's going on in terms of the markets, parts of the country starting to open, other developments and implications. And we are very fortunate to have David Lee, Managing Director of Laconia Venture Asset Management, on the call with us today. David has over 20 years of alternative asset management experience, and Klingenstein Fields has worked with David and his colleagues at Laconia Capital on different venture capital investing initiatives. David is going to give us an overview of venture capital in the current market environment, some historical perspective, what it means for investors, and some thoughts on how we approach venture capital. After that, we will answer as many questions as we have time for. Any questions that we do not address during the call, we will follow up with individually to make sure that they are addressed. During this call, you can submit questions in one of two ways. If you're listening through your computer, there's a widget on the right side of your screen where you can submit questions. Or you can email them at any time to Susan, S-U-S-A-N, .Curry, C-U-R-R-Y, at Klingenstein, KLINGENSTEIN.com. So let's begin with a recap of what's happened since we last spoke. In the last few weeks, after peaking in late April, we have seen new cases of coronavirus slow overall, and in many parts of the United States, particularly, as the positive impact of control measures have been felt. Even in hard-hit New York and surrounding areas, where we're calling you from today, the news has been particularly encouraging, with a sharp drop even in New York City in daily reported cases, from a peak in early April of over 10,000 new cases per day to fewer than 3,000 per day as of last week. Several states, including New York, are easing some of the restrictions, and we are watching carefully to see what happens. There's still a great deal of uncertainty regarding the final severity and tenure of the expected social and economic impact of the virus, and this is reflected in ongoing market turbulence. Volatility that we have seen should remain. We've seen that again, not only this week, but even today. While we have not seen a return to the lows that the markets and indices hit on March 23rd, last week the U.S. stock markets did drift lower after grim April sales figures and continuing unprecedented historic unemployment numbers. Though last Friday saw some recovery based on the loosening of the stay-at-home measures and expectations that this will lead to some level of increased economic activity, coupled with optimistic remarks by Jerome Powell, the chairman of the Federal Reserve, the market continues to move very sensitively on news, reacting as well to optimistic stories about COVID-19 treatments and vaccines. In fact, the big run-up in the market on Monday was driven in large part by Moderna's positive vaccine results. Similarly, Tuesday's fall was partly driven by skepticism of the applicability of the data from such a small sample. As expected, we are also seeing continued fiscal and economic commitment and support from the Federal Reserve and the central government. Chairman Powell this week emphasized his arsenal remains robust, and that is on the heels of the House of Representatives' $3 trillion spending bill passed last week. Even if the Senate cuts and modifies that bill, more fiscal stimulus is coming. However, we've also seen the beginning of some of the fallout from the economic downturn. Retail sales were down year over year in April in double digits, a record, besting the previous record from the month prior. And clothing and apparel have been among the biggest victims. The impact is severe, and in May, J.Crew, JCPenney's, and Neiman Marcus all filed for bankruptcy. Other companies and industries, such as energy, entertainment, and travel, are also vulnerable, and airlines could be particularly threatened. We're carefully watching to see what happens as businesses begin to reopen. Our focus, as always, is on high-quality investments with strong fundamentals. While even well-managed firms may feel the short-term impact of the coronavirus and the response to the virus, we believe that in the long term, they will weather the impact of events such as these. In addition, we are monitoring portfolios and looking for buying opportunities as we deploy unused cash and rebalance portfolios. So that's where we stand now. Again, we encourage you to reach out to your advisor with any questions regarding your portfolio. Now I'd like to introduce David Lee, who's going to talk to us about venture capital investing. David will be using some slides for those who've joined by computer. If you've joined by phone, a recording will be available after the call. Once we receive the recording, we will send out an email with information about how to access it. David?
Thank you, James, for having me on the call today. My name again is David Lee. I'm with Laconia. We are a venture capital firm that provides outsourced venture advisory services, as well as manage several venture capital funds themselves. Before we go into my slides, I thought it might be helpful to define what we mean by venture capital, since there are a number of terms in private investing that are often used interchangeably. Venture capital falls within the broad alternative or non-traditional investment category, which we typically think of in two subcategories: hedge funds and private investments. Within private investments, there are also two subcategories: private equity and venture capital. Private equity deals are generally controlled transactions where companies are acquired with leveraged debt. In venture capital, minority investments are made in companies which are at various stages of startup. While you may find different classifications of these stages, we divide them into 5, ranging from seed stage, where one is essentially investing in an idea or a concept for a business, through startup, first stage, second or expansion stage, then finally to the mezzanine or bridge stage, where a company has reached the point where it is either preparing to engage in a transformational event, such as going public or being sold to a complementary business. Okay, let's get started. So you may wonder why venture capital is so important. First, many venture capital investments are in innovative companies, which perhaps right now is more important than ever as we make more use of innovative technologies and remote ways of conducting businesses. In fact, almost half of US publicly traded companies in the last 30 to 35 years began as venture-backed companies. Even more dramatic is the total market cap and R&D spending represented by these companies. 86 of R&D spending of US public companies were venture-backed. If you look at the market capitalization of the 10 largest global companies, you'll see that 7 of them, all familiar names, started their lives with venture capital. While many venture-backed firms do not make it, the number of unicorns or venture-backed firms that reach a $1 billion valuation mark has increased dramatically over the past decade, showing the impact of venture capital in both the markets and the economy. The current environment is accelerating and creating even more potential opportunities. And we anticipate that the way we are living and working now, while perhaps not permanent, will drive long-term change and growth of industries such as e-commerce, e-business operations, including cloud computing, and entertainment access. In fact, when you look back, some of the most innovative ideas and companies started off as venture-backed companies during economic downturns. Downturns sometimes spur innovation as individuals and firms look for new ways to survive and thrive. Professionals find uncertainty with their current companies, may choose or be forced to pursue new ventures. Also during downturns, the delta between the cost of doing business as usual versus trying something new decreases substantially. So as you can see from the logo, these are some of the various major companies that were formed during downturns and were backed by venture capital. So why should eligible investors consider venture capital? Historically, long-term performance, while not an indicator of future performance, has been very strong for venture capital versus other asset classes. In this slide, you can see the 3, 5, 10, 15, and 20-year returns of venture capital versus the Russell 2000 and the S&P 500. You can see that long-term, the performance is extremely strong, but even over the short 3 and 5 year period, they have outperformed large and small cap domestic equities. But patience and a long-term perspective is required to be in venture capital. Venture capital markets are cyclical in terms of interest and funding, generally moving similar to what's going on in the public markets. At times, the impact of other markets on venture capital is more pronounced, as in the early 2000s when the tech bubble burst, or during the financial crisis of 2008-2009, which had a more moderate downturn and a quicker recovery. In terms of VC investing, like public markets, capital tends to flow towards investments and asset class that have experienced strong performance. Following that, investors stop investing or start to sell on the perception that good investments are either too scarce or overvalued, leading to declining returns. When the public markets also go down, investors seek to increase the liquidity by reducing venture capital commitments, driving venture valuations further down. Once the economy and the market starts to improve, though, this cycle begins again. So downturns often create opportunities for investing in venture capital. But we must remember it is difficult to time these markets. Some of the greatest investment vintages came during the difficult market environments. In addition, research shows that trying to time the venture capital market shows very little modest advantages. Rather than timing the market, a long-term, forward-looking perspective that seeks to find the highest potential investments regarding of timing is a more strategic approach. The reason is that fundraising can be very specific to a deal. A great company can be born at any time. And again, accessing the high performing funds can often be difficult, and that often drives demand. So how do we approach venture capital investing? We have a number of core tenets that form our approach that I will take you through now. First, diversification improves your chances for returns and helps manage risk. We believe in diversifying across a range of funds and co-investments, sectors, and vintage years. Because companies are small, we can deploy capital across a wider range of investments while still achieving meaningful positions. Second, manager selection is critical. You need an advisor who is experienced in venture capital, follows a disciplined process, and has access to a diversified range of managers and investments. The difference in performance between the top performing managers and even an average manager is significant. In this chart, you can see the delta between the top percentiles and the lowest percentiles versus other asset classes, where venture capital has the widest disparity. In addition, in venture capital, success does seem to breed success, which is why finding the right fund partners matters. Success in venture capital and performance does not appear to be random. Research tells us top performing venture capital partnerships tend to remain top performers with their subsequent funds. This holds true regardless of fund size. Conversely, poor performers tend to remain in the bottom quartile and fail to beat the public markets. We also focus on newer and smaller managers. We want to find the funds that we believe hold the highest potential, and new and developing funds have been among the strongest venture capital performers and consistently appear in the top performers across a prolonged number of vintage years. This chart, if you look at this chart, the boxes in the light green are newer funds. The dark green boxes are developing funds, whereas the gray boxes are more established funds. As you can see across multiple years, among the top 10 funds of those vintages, you will see that at least half, if not the majority, are new funds or developing funds. This is probably because the newer funds focus on emerging investment areas, and also in part because the newer funds tend to be a little smaller and they have outsized impact from their winners. We also concentrate in secondary and tertiary markets. 20 to 30 years ago, almost all of venture capital was centered in Silicon Valley. Today, we find new emerging centers of entrepreneurship in New York, Chicago, and Denver. We find these growing markets attractive due to size and diversity of opportunities, along with more attractive valuations. The attractive valuations come from having startups that are further developed along at similar investment stages, which help reduce risk while still providing significant upside potential. These potential valuations and prices are also from the fact that these secondary and tertiary markets are less saturated and less competitive. We also selectively pursue co-investments, where fund relationships can provide opportunistic investment opportunities at attractive pricing and fees. These co-investments allow us to cherry pick the best companies within these funds' portfolios leverage the fund's existing infrastructure, expertise, and relationships, while often getting attractive pricing and fees in these deals. Finally, we couple that with the use of fund-to-funds, as they can play an important role in a person's venture capital allocation. Fund-to-funds can control costs, achieve greater diversification, and gain access to managers that one might not otherwise be able to access. Research has actually shown that fund-to-funds deliver performance net of fees greater than or equal to the public market equities, despite the fact that you might be paying slightly higher fees overall. So what are the lessons for the long term here? One, we see upside opportunities in a number of sectors in the new world we live in. Remote learning, e-commerce, enterprise networking and security, healthcare IT are all areas that we have seen substantial increase in demand and need just in the last couple months of this pandemic. You need to partner with high quality managers. It's not as easy as it sounds, but as we showed earlier, the best managers outperform and outperform longer. Most importantly, you need to diversify and have a long-term mindset. The strongest upside potential arises when you are able to commit to investing for the long term. I hope that provides a good overview of venture capital and our approach to investing in venture capital. Overall, we believe that venture capital can be a potentially rewarding asset class, although venture capital investments can be less liquid than public markets and do carry a higher level of risk. However, even during these tumultuous times, if you have the right long-term perspective, venture capital, we believe, will pay off in the end.
Thank you, David. That was an informative overview of the current environment for private investments and the implications and considerations for investing specifically in venture capital. Thank you for laying out the key elements of the approach that we've developed for venture capital investments at Klingenstein Fields. We at Klingenstein Fields Wealth Advisors have decades of experience investing in the private markets. We're happy to discuss those with you directly. At this time, I'd like to open up the call for questions. Again, if you're listening through a computer, you can submit questions through the widget on the right side of your screen, or you can email any questions to Susan, S-U-S-A-N, .Curry, C-U-R-R-Y, at Klingenstein, Klingenstein.com.
Great. So we've had a few questions come in. I'm going to field them and I'll ask either James or David to answer the questions. Thanks, everyone. All great questions so far. First one, I think this, David, I'm going to lob this one to you. You mentioned that venture capital can be risky. It seems riskier than other investments. You've talked a little bit. Can you talk a little bit more about what you do to reduce risk when you're investing in venture capital?
Sure. So I think the most important thing is diversification. You don't want to put all your eggs in one single investment or even just one single fund. I think the best approach is to have diversification across different sectors, as well as different managers and different investments, because the risk reward is such that you really want the opportunity to have as many different shots on goals to find the high performers. So I think the biggest thing for reducing risk is proper diversification. The second is also having a long-term perspective. You can't make venture capital investments just in 1 year. You got to spread your investments consistently over multiple years, and then over time, hopefully those investments will self-fund and you can maintain a consistent portfolio of venture capital investments. You see that with university endowments to great effect, Yale University being probably the best example of that. So I would say it's a matter of diversification and having the long-term perspective to invest over many years.
Great, thank you. Next, there are a couple questions. They seem to kind of go together. I'm going to give those to you, James. And that's related to, is there a level of assets you should have before you invest in venture capital? And, how do you decide what percentage of asset allocation you should put into venture capital?
Thank you, Ellen. And that's a good question. It's one that we think about frequently. There's no simple rule of thumb for the correct percentage to allocate to venture capital. I usually think of the right allocation, in addition to being idiosyncratic for each client situation, as being driven by three factors. First is the asset size. What is the pool of assets that the client, whether it's a family or an institution, has overall. The second, and probably the most important piece, is need for liquidity. Venture capital is a traditional illiquid asset class, and it's very important to understand in modeling future liquidity needs for a client that they will not need to call on the allocation of venture capital, at least through the investment period, if not, which is typically 3 to 5 years, or likely for the entirety of the investment, which can be 10 years or more in some cases. And the third is risk tolerance. It is important to assess the client's risk tolerance, and that is not always the same as the client's own perception of risk tolerance. So to talk through the understanding of the losses that can happen in private investing, which in some cases can be total loss. There are many venture-backed investments that have tremendous returns. Those are the ones that we talk about. And it's equally true in terms of numbers, more true, that many of them become worthless. And that is a risk-reward calculus that differs from the public markets, where if investments are going against you, you have the chance to sell out before their total loss is realized. So again, simplifying it, it's idiosyncratic, driven by the total corpus of assets available, the need for liquidity, and the true understanding of risk tolerance for the client.
Great, thank you. The next one, or it's actually two, I'm going to send over to David, somebody who obviously is pretty interested in venture capital. How will a tough IPO market and a tough capital market make exits work for VC deals? And will returns come down due to exit delays for deals, whether they're initial public offerings or strategic sales?
So I think the benefit of being in venture capital for the long term is that you are not subject to mark-to-market constraints like you might in public equities. So while obviously a depressed public market and an IPO environment will make it take longer for a venture investment to get realized, if you have a good company that is showing solid growth and high demand for its services or products, you can have the benefit of waiting it out. An IPO is, a liquidity event. It is not the final event for an investor in venture capital. I mean, if you look at some of the companies we saw before, whether it be Google or Amazon, they were successful venture investments and they were successful public company investments. So I think that, again, we go back to the long-term perspective here. Typically over the last 20, 25 years, bear markets or in the public markets have lasted anywhere from 6 months to 2 years, and then have emerged strong on the other side, and that's when venture capital exits have happened quite naturally. So I think it's a question of short-term versus long-term, and in the long term, if you have a great company that is meeting a need and has strong fundamentals, eventually you'll be able to access those markets and realize good exits. What was the second part of your question, Ellen? I forgot.
I'm sorry. It was similar in terms of, will that cause delays in terms of exits from deals?
Right. Yeah. But, so I mean, I think along those lines, it will cause delays, but it shouldn't cause diminishments of multiple of investment returns. So over the long run, companies should get valued based on their top line growth, free cash flow generation, profits. And as long as a company continues to grow through the downturns, you will still be able to realize great multiples of invested capital.
Okay, great.
This is James Fields, Ellen. I will just add, I agree with the points David made. I think when we think about venture, the vast majority of successful venture stage companies that do exit through strategic sales. It's actually a very small percentage that end up in the public markets. It's really the tremendous winners that you think of, and David mentioned, that end up in the public markets. Most successful venture stage businesses are acquired by other large businesses, often themselves backed by later stage private investors or by corporates. And I think that those opportunities, I think, will exist even with the IPO window being temporarily, if not fully closed, at least closed in part. And so I think we'll still see that. As you probably know, though it wasn't part of today's discussion, tremendous amounts of capital have been raised throughout the private equity, quote unquote, stack in the last few years as allocations to alternatives have gone up by the big backers of private investing, pension funds, endowments. And there's tremendous amount of capital on the sidelines looking for strategic acquisitions of growth stage companies that are typically venture backed.
Great, thank you. The next one is two questions. I'm going to ask them individually. The first one, which I think kind of relates to the second and tertiary markets, do you believe that there will be a continual move by entrepreneurs to outside the dense cities given the current pandemic coronavirus? David, can you take that one?
Sure. I'll be honest, I think it's a little bit too early to tell. I think that one thing that will definitely be true is that remote working will be on the increase. That company, I think even Facebook today, Mark Zuckerberg said that he expected most of his employees to be remote workers over the next, I think, several years. So I think that there will be an increase in remote workers. However, I think that companies themselves will still be headquartered and domiciled in the major cities of New York, Chicago, San Francisco, primarily because that's for a couple of effects. One is obviously access to services, service providers, whether it be law firms, banks, accounting firms. And also, I do think that there is some value to that networking is not going to go away, i.e., people still need to interact with each other, and you will have that easier where you have major cities like a San Francisco or a New York. Zoom networking, I don't think long-term is effective for getting deals done or meeting with customers or things like that.
Great. Next question, and says addressed to David, so I'm going to lob this to you, David. Has your strategy for valuing future venture capital investments changed in the pandemic experience, since nobody knows quite what the new normal will look like and when markets will stabilize, et cetera?
Great question. Again, it's a factor of short term versus long term. I think that the basic tenets of investing in funds and in the co-investments don't change. I mean, when you look at investing in venture capital funds, you're really looking to find strong investment managers who have domain expertise, who have a network to leverage that expertise, and also have created some sort of differentiation in terms of their investment strategy. What some people like to call, the special nugget that gives you confidence that they will outperform. Similarly, with looking at companies to co-invest in or making direct venture deals, you're still looking for great entrepreneurs going after large markets or unsolved problems that have demonstrated, hopefully, an ability to execute against those problems in the past. So I think that what has changed has been that certain areas have probably increased in prominence or importance. Things like remote work or remote learning, healthcare IT for sure. E-commerce, is just accelerating now that more and more people have gotten comfortable opening shopping from home. And then there's all the underlying infrastructure related to those changes, whether it's logistics and transportation, or the infrastructure to help manage healthcare IT and things like that. So I would say that the landscape has probably changed in terms of where the large opportunities might be, but the underlying tenets of what you look for to take advantage of the opportunities have not changed.
Great, thanks, David. Next question, I think both of you are going to want to answer it, so I'll start with you, James, and then David, you can chime in. Can you provide some examples of the factors that contributed to your greatest successes and failures? So double-edged question.
Wow, that's a really good question. And I would say in terms of the failures are easier to enumerate in the sense that those are sort of done, and the greatest successes, we certainly A, hope are still to come, and B, maybe not even fully realized. But on the greatest successes, I would say it is finding a founder or a leadership team that is extremely passionate, fully dedicated to the vision for their business, and not just as a concept, but how that business will fundamentally change. I won't be as trite as to say change the world. I think that's maybe too far to go, but change the sector or the industry, the vertical that they are tackling, that they have a clarity of vision and purpose, energy to pursue it, and a sense of how to do it with both the confidence to overcome the inevitable setbacks, but the humility to recognize when they may have to pivot. I think some of the great successes we've seen, including those that I mentioned on this call, along the way, there were several pivots that we may or may not think of now when we think back to the history of some of these leading technology companies. I think in terms of failures, they often have different bedfellows, but it can be things in my own experience, changes in the regulatory regime, a difference in the need for capital versus plan. Raising insufficient capital is often the case that entrepreneurs understandably want to maintain as much ownership in their businesses as they can, but often that can lead to undercapitalization, and that may not matter when things go perfectly well, but I've rarely seen a business plan, a projection that was hit perfectly. It is often the case that additional capital either should have been raised or is otherwise needed. And for those entrepreneurs or leadership teams that raise more than they need and don't have to go back to market at the wrong time, they tend to be successful. So my experience with the failures that were driven by undercapitalization, changes in regulatory regimes, the TAM, as we say in our industry, the total addressable market, just not being there. You're just wrong. The market changed. The opportunity didn't exist the way you thought it would. Of course, there's always disintermediation. It's rare if you meet an entrepreneur who says, I'm the only person thinking of this who has ever thought of it. That's extremely rare. The human ingenuity is global. It is without gender or race or age. And the humility to think that maybe you have a better mousetrap, but you're not the only one attacking it. We've seen failures because someone else actually did have a better mousetrap and disintermediated you, even as you were thinking of disintermediating the market you're after. So that's a handful of the things that I've seen, and I'm sure David has even more.
I think you hit most of the big ones. I mean, in terms of successes, I think it's a combination of, it always starts with the team and the founders and the subsequent people they bring on to take advantage of the second most important thing, a large opportunity or a large need. And that can be manifest in two different ways. It could be a large current opportunity that can be done better or cheaper, or it can be a large opportunity where someone saw a new way of doing things and were able to leverage different technologies or infrastructure to take advantage of it. But again, it goes back to that founding team being able to execute against it. So I think it starts there. It starts with a large opportunity or a large market. And then thirdly, it starts with, timing, right place, right time. And I'll give an example of that, which goes back to some of the greatest failures. I was making venture capital investments back during the dot-com age, and we had, some successes, but we had a number of failures. And what's interesting is if you look at some of the most, famous failures back then, they have now turned into be some of the most successful companies 20 years later. I mean, everyone remembers pets.com with the famous sock puppet, but there's a public company that PetSmart just took out of, and I apologize, I'm not a pet owner, but has done fantastically well selling online pet supplies. The other one that people made fun of was Webvan, the to-home grocery delivery. And look at DoorDash and Grubhub and Instacart these days. So sometimes, you just have to have the right tailwinds, which again goes back to why long-term perspective matters here. But that said, there are great opportunities always across all timelines. And it's really about finding the team who's able to execute against it better than anyone else.
Great, thanks, guys. Great answers. I think we have time for a few more questions. Next one is, how do you avoid dilution of your earlier investments? David, maybe you want to take that one?
Sure, and then, James, you should give your perspective. So I think if you invest in early stage companies, dilution is pretty much inevitable. It's very rare that a company will raise, single digit millions of dollars and never need additional capital. It has happened, but that's on the lower end of probability. So I think that to avoid dilution, there's several things. One is to make sure you have what's called pro rata rights in future financings. That means that anytime there's another financing round, you have the right, but not the obligation, to invest the dollar amounts necessary to maintain your ownership. The challenge there is that as companies increase in valuation, the amount to put in to maintain your ownership percentage can be, very, very large. So at a certain point, it becomes very difficult to do that. So the second thing that you want to hopefully try to do is have enough of an ownership in the beginning so that if you do suffer dilution, if there's a strong outcome, you still own enough that it will have a huge payout. So, if you own 0.1% of a company that winds up being a unicorn, it's still a pretty good payout versus, I think that's $10 million, as opposed to owning, 2% of a company that might have, a more modest payout. So those are the two things that I think you try to maintain as best as possible. James, I mean, you had some, experience with this as well. Any other thoughts?
I would just first I'd echo your first point, which is that part of the way to handle dilution is through structure. So making sure that the series of investment you're making is properly structured, that you have the right and the opportunity to invest. The second piece of it is a combination of having dry powder, which has to do with structure of your investment vehicle. So our strategy historically has been to spread our bets not too wide, but leave enough capital that as businesses mature through the venture growth process and the natural winners emerge, that you have the ability to exercise those rights that David mentioned, and you have dry powder available to put into the companies at higher valuations, even if it's not to fully protect the amount of dilution, but to at least to mitigate some of the impact of the dilution from these scenarios. Generally speaking, dilution occurs in businesses that are going well and raising more capital, and it's sort of a virtuous problem. But there are certainly cases where there's terms we haven't heard in a few years, the cram downs and down rounds and things like that, where new capital coming in can wash out old capital, even in a company that's struggling. And in those cases, you may not want to be putting more money in. So it's both a structural issue of having the right structure in place to have the right to do it, and then having the capacity in terms of capital available to follow on.
Great, thank you. Here's a great question, kind of a two-parter that came in. In terms of sectors, are there ones you particularly focus on? Has that shifted in light of the current events? And are there any that you're reluctant, even in venture capital, you think they're just too risky? James, you want to tackle that?
Sure, and what we might believe does not necessarily mean it's applicable to all investors. We have fewer sectors that we avoid than we do ones that we're interested in. We're interested in a broad range of sectors, really coming down to factors that David mentioned in his presentation of finding great managers, both of funds that have domain expertise or of businesses, entrepreneurs that we think are, really have an edge in some way, either in terms of their own abilities or their vision for their business. There are sectors that historically we've avoided. We've avoided things that are capital intensive. We think that at the venture stage, we've avoided this mostly, and the few times we've, long ago when we didn't avoid this, we learned why we should avoid it, which is capital intensive businesses at the early stage require so much capital. And to the previous question, the potential for so much dilution, that it's rarely something that we get comfortable with. The second area that we have historically avoided is biotechnology. And even though biotechnology is a large subsector within venture, it requires real expertise and tends to be very much what we call hit-driven businesses. It is very much the case, if you look at fund families in biotechnology, that they can have a number of fantastic fund outcomes and then a number of ones that are poor performers, only in that the underlying science and biotechnology is just so difficult to discern unless you have real expertise, which we do not claim to have. So those are two areas we tend to avoid. In terms of sectors we like, David touched on a few things about remote learning, around e-commerce, around new ways of working, new ways of interacting. All crises create winners and losers. We're seeing that now. You're seeing that in public and private markets. It is very much the case, without naming any specific names, that there are things when we look at our own portfolio, companies that are having revenue off the charts because they were well positioned for a world where folks were forced to stay at home, and others that are struggling because they relied very much on social engagement and interaction. And that's equally true in the public markets, as we've seen. So it is, it's things that there are winners out of this, and I think that will continue to be the case, but there are very few sectors that we avoid. I think, David, maybe you can touch on some of the sectors that we've looked at together, broadly speaking.
Yeah, I mean, again, without getting specific on any particular company, the last, this pandemic has actually been pretty interesting from a standpoint of winners or losers, or what I would say more applicably, accelerating trends that we had already seen happening in the economy and among consumers and businesses. So, for example, direct-to-consumer food has really exploded over the last 2 months. There were, we're familiar with a couple of companies that provide direct-to-consumer food either through subscriptions or carts, and they had been growing very nicely over the last couple of years. And within the last 2 months, their growth has exploded from 100% annualized to more like 300 to 400% annualized. And we're confident that that growth rate might slow, but now that people are comfortable with that, what the product and the service is, you'll get that. We also see things where remote education or learning or sharing of media or information has also been doing extremely well. And I think that will continue going forward as well. And then, on the business side of things, anything that is related to networking, security to obviously protect the networks and the interactions are all just continuing to increase in demand. So I would say those are probably the couple areas that really seem to be exploding right now.
Great, thanks, David. Thanks, James. One question just on clarification on a point in the presentation. You mentioned that new funds tend to be new and developing funds tend to be the best performers, but you want to find managers with a proven track record. Does that mean you're also looking for, when you say new funds, are you also looking for new managers? Or are you mainly focusing on managers that have been proven?
Yeah, so, and we'll get, this is a continuum of investment criteria. So let me see if I can try to parse it out. I would say that in general, first-time funds are typically not a high priority that I would recommend unless it's, fund managers who had established themselves at a place, one of the leading firms and have gone off to do their own. That might be the one exception. But people who have never managed a fund, tends to be lower on priority just because it's, no different than a startup company. It's something new and you want to see how things develop. So I would say, but that having said, funds that are raising their second or third fund or possibly the fourth is probably the area of where the strongest interest is. You start to see the track record and the ability of the managers to execute their strategy, provide areas of distinction, and finally reference the deals they've done and the other investors they worked with.
Great. All right, I think we're going to take one more question because we are running out of time. Thanks, everybody, for the great questions. This has really been great. So, James, given that remote way of doing things, business, groceries, et cetera, are very popular right now, how do you sort of figure out when the market is oversaturated with people doing that, or how do you judge whether the market is saturated, and so then you've got too much competition and the business model starts to break down?
Sure, that's a great question, because it is very much the case that many of these good ideas get quickly crowded. I think part of the way to address that is most of the great markets, when I think of a great market as a large total addressable market, have room for multiple winners. And what you also see is, you see in the business cycle of these sectors, you see first multiple winners, and of course many, many losers, and then a consolidation among those. In fact, you're seeing it even at large scale with Uber Eats trying to buy Grubhub specifically, right? So I think our job is to assess, what is the management team like? What is their differentiation versus their competitors in a competitive space? Why do we think they'll be among the winners? Are they properly capitalized? Do they have the opportunity to be among those that consolidate or are consolidated as a large competitive market is rationalized? And that is a series of things that we're trying to assess when we look at competitive markets. We always believe that any good idea that we find will invite competition. And it's, again, as I mentioned earlier in a different context, it is rarely the case that there's a singular winner in any one. So that is how I would think about that.
Sorry, my apologies. I lost the connection. I'm back.
Thank you, David. I was just talking about how you think about dynamic markets. If there's something very competitive like right now, e-learning and working remotely and online groceries and e-commerce, how we think about investing in things where there's going to be certainly a fair amount of shakeout. And I mentioned the fact we try to pick winners with an edge that in areas that'll have consolidation and make multiple winners. So thank you everyone for the questions. Again, this is James Fields. I want to thank everyone for attending. I wanted to address something that's come up, which is not related to the content, but was asked in the questions about returning to the office. Klingenstein Fields, and I think this goes equally well for Laconia, our partner in today's call. We are a human capital business. What matters most to us are the people listening, our clients, and their health and well-being, and the health and well-being of our colleagues and partners. To that end, we are letting safety and security of our people dictate when we might all return physically to the office. Our office happens to be right in the heart of New York City, which will be probably the last place to open. We are real time working with each other as colleagues and with the folks who run the building that we work in, and of course, paying attention to the governor and mayor and transit authorities. I think it will be a number of weeks until we're all physically back in the office, if not further than that. What we have found and was mentioned on our previous calls is that from the point of view of being able to work with one another and work with all of our clients, it has been a seamless transition to working from home for our folks. We had been testing working from home in groups and individually for the last few years. And so this transition was, while not for good reason, certainly something that was as seamless as we thought possible, if not frankly better than we thought was possible in terms of all the systems and operations being able to be done from, in our case, 42 different locations. So thank you for that question. We hope you found today's discussion on venture capital in today's environment interesting. If you have any additional questions regarding venture capital or the potential role in your portfolio, please reach out to your advisor at our firm or any of us at Klingenstein Fields. We will continue to keep you updated on our perspective on what's going on in the markets, as well as any other special topics of interest. And certainly we welcome thoughts on topics you'd want to hear about. We hope you have a safe and relaxing Memorial Day weekend. Stay well, and we look forward to speaking with you soon.